Okay, guys, true or false? 90% of equity funds, which includes hedge funds, pensions, mutual funds, do not beat the market, meaning they do not beat their equity index benchmark, such as the S&P 500 index. This statistic is so often quoted in arguments for why regular laymen like us shouldn't try to actively trade and beat the market, because if the pros can't do it, then you can't either. It's also quoted in arguments for dumping all your money into passive index funds. If the index beats other funds, why not invest in the index? But is this actually true? And if it is true, why is it true? Like, this is so weird. What's going on? If I told you this was false, I bet many of you would nod your heads because, yeah, it makes sense that this would be false. I didn't even believe this when I first heard it. I thought that it was some kind of made up or misinterpreted rumor, like how the average human eats 69 spiders in their sleep or something. I bet there's also plenty of you that have heard this statistic before and believe it to be true. Now, this went against the entire image of the investing world that I was taught in business school, and it went against the lofty reputations of the investment firms that seemed so elite and honestly cool. They knew things that I didn't know, like portfolio, blah, 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 blah. Jesus. I can't even say it. That's how complicated it is. Portfolio optimization algorithms. They have fancy discounted cash flow valuation models that I didn't understand. They wear suits and get paid a lot, and they spend their entire days researching the market. I think it was my dad who told me this statistic, and I told my dad, bro, no way. I think you have it wrong. Shouldn't it be the exact opposite? Like, shouldn't 90% of funds beat the market? That's what they're paid to do, right? It just doesn't make sense to me. Let me Google it. I Googled it, and I found the report where this number comes from. And no, I did not find this on Motley Fool or Wikipedia, although Wikipedia is actually really good. But this is straight from Standard & Poor's, the creator of the S&P 500 index. Standard & Poor's is a regular fund performance report that gives this exact statistic, link in the description below. And here's a screenshot from the June 2018 report showing what percentage of equity funds were outperformed by their equity index benchmarks. This report is saying that in the long term, 89% of all equity funds lose to their index, whether they're large cap, mid cap, or small cap funds, and regardless of their investing style, across growth, core, or value styles. Okay, but how much is it saying they're losing by? We can see here that the 15-year average index return was 9.5%. The fund average was about 8.5%. So on average, funds are getting 1% lower returns than the index to their clients. And Warren Buffett, the Lord, knows this too. He was so confident in the reliability of indexes outperforming hedge funds that in 2007 he made a $1 million bet that hedge funds would fail to beat the market over a multi-year period. I think maybe it was a 10-year period. And he was right. He donated all $1 million to charity. What a good dude. So what exactly is causing this statistic of 80 to 90% of funds losing to their indexes? Does it mean that we shouldn't let mutual funds or hedge funds manage our money? Are they scamming us? If the pros can't beat the market, does that mean it's hopeless for you or me to try to beat the market? Should I dump everything into penny stocks and crypto, or should I just stick with my dreams of becoming a world-class bank robber? Let's explore the answers together as we dive deeper and deeper into this mysterious world of investing. Okay, before taking this statistic at face value, let's be critical of how this statistic is defined because there's two details here that are very important. First, what do they define as an equity fund, right? Because let's say I have a mutual fund that's 75% equities and 25% bonds. Of course, it's not going to beat an equity index in the long run, and it's not really trying to either. It's not designed to do that because it has 25% bonds that have lower returns in exchange for lower risk, low risk, low reward. Would this be considered an equity fund, right? It's still 75% equities after all, even though it's not really fair to compare it against a 100% equity index. So the S&P report that I showed you earlier uses the Lipper fund classification, and looking at the 2019 Lipper global classification definitions, they say that as a general rule, a fund must hold a prevalent exposure with a threshold set at 75% of its portfolio in order to meet the requirement. So they're applying the 75% threshold to their definition of equity fund. That means a lot of funds aren't beating the equity market because they're not trying to. Some of these so-called equity funds may have lower risk assets like bonds to provide more stable returns, although, lower yielding than an equity index in the long run. The second reason is that this number is adjusted for survivorship bias. They consider any fund that was acquired or merged with another fund to have lost to the index. So I can kind of understand why they have this adjustment, because funds often get acquired or merged because they weren't doing very well, but that's not always the case, right? Right now they're considering a lot of successful funds that just happen to be acquired or merged as having lost to the index, and that's not really fair either. So these two reasons probably explain a lot of why the number is as high as 80 to 90% of funds losing to their equity index. One, because they're not trying to beat the equity index. They're not designed to do that, and that's okay. And they're also declaring funds that were acquired or merged as losers. So this number is exaggerated and inflated, but still, even accounting for that, 90% is a really high number. And there are other big reasons why funds aren't beating the market. So let's get into those. Reported returns from the S&P report are net of fees, meaning that fees are subtracted from the fund performance to represent returns to the client. How much are fees? 1 to 2% of your portfolio value. That alone is a significant barrier to overcome for funds trying to beat the market. Now, 1 to 2% sounds harmless, but that's how they get you. Let's say that we invest $100 when you're 25 years old and then withdraw it 40 years later when you retire at 65. So if you invested it in an S&P 500 index fund that averaged 7% annual returns, no fees, we would have grown $100 to $1,400. If we had given that $100 to a fund that performs the same as the index except it charges a 1% fee, so you get 6% annual returns, we would only get $970 upon retirement, and that's 30% less. How did our 1% fee suddenly turn into taking 30% of our wealth over 40 years? Well, that's the power of compounding, and funds understand this. Sadly, many of their clients do not. So in that example, the fund performed the same as the market but charged a fee. If a fund promises they're trying to beat the market but are mostly just mimicking the market, they are what we call closet indexers. Closet indexing is extremely common, and most people don't realize that they would be better off buying an index fund that only charges like a 0.2 to 0.5% fee instead of leaving their money with a closet indexer. Most folks just want to park their money and get some returns, and they're not really paying attention to this 1 to 2% fee. But from the example just now, we know that closet indexing takes at least 30% of your wealth over a 40-year period. So why are so many funds closet indexing? Why don't they just try to beat the market? That leads us to reason number 3. So funds face unique challenges that regular investors like you or I don't face. First, portfolio managers that work at funds, they're scared of losing their jobs. Their performance is reviewed based on how well they did compared to an index. If they lag behind the index too much, they get fired. If they do a lot better than the index, they get a bonus. But when you're already getting paid such a large salary and you have a family to support and bills to pay, why take the risk to outperform the index when you can be safe in the closet and collect that thick salary with no worry? Why are people scared to try to beat the market? Is it really that hard? It's their job. Okay, well, yeah. The fact is, it's hard to promise that you'll beat the market every single year. It's not impossible. A lot of people do it, but even the best of them can have bad years. No one wants to risk that one bad year and lose their job. Second reason, as funds get bigger, they have so much capital. They can no longer just buy a small selection of high-performing stocks. They have to distribute their capital into more stocks and bigger stocks. But the more stocks you own and the more large cap stocks you own, the more you start mimicking some sort of index. All right, guys, thanks for sticking around to the end of the video. We talked about a lot of different things. So just to keep it simple, why don't we look at what we've learned and summarize things in some key takeaways, right? What did we learn? We learned that that statistic, 90% of funds losing to the market, is exaggerated, right? Because it includes multi-asset funds with at least 75% equity, but it could be up to 25% other stuff. So it's not really fair to compare it against a 100% equity index. Secondly, they're considering merged and acquired funds as losers, which isn't always fair either. So the statistic is exaggerated, but still lots of funds find it hard to beat the market. Why? One reason is because they charge fees. And we learned that, even though it's just a 1 to 2% fee, it can be extremely significant over time due to the power of compounding. So be careful about that. Also, watch out for closet indexers. There's lots of them out there. You should be checking the performance of any fund that you put your money into to make sure that you're getting your bang for your buck. Finally, we learned that, funds face these unique challenges that retail investors like you or I are not going to face, right? They fear job loss. And also, because they're so big, they have to deal with potential over diversification problems as well. All right, guys. So this was Strong Stonk talking the whole time. This is my first YouTube video ever. So I know that this video was probably, long-winded on kind of a strange topic. I'll get better at it. If you want to stick around and find out more about finance and explore this world of finance together, in the future, I'm going to be posting more explanations and deep dives onto certain investing and finance topics with regards to value investing in particular. Stick around, subscribe, see what happens, and hopefully get to talk to you in the comments. See you guys.